Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And before I get started today, I wanted to just take a moment to say thanks to all the people who have written. You can always write to me, inflationguy at enduringinvestments.com. For all the people who have posted this podcast to other people, who have referred others. This is our 29th episode, and we've had 17,000 downloads or so, and that seems like a lot. I'm a novice. I don't really know a whole lot about this stuff, but it sounds like a lot of downloads. So, to the extent that it is, I just want to thank everybody for your support, and like I said, for referring others. So, now let's talk about what we came to talk about today, and that is housing. But today, actually, I'm going to talk about housing, but not for housing's sake. Housing, we've had a couple of housing numbers, some housing data over the last week or so, and it is really illuminating. The reports last week and this week, and the reaction to them amongst investors and the press illustrates marvelously some errors, some cognitive errors that are being made right now. And I'm always fascinated with cognitive errors. I think that it's really interesting. And if you're an investor, if you're a trader, you kind of, that's sort of what you traffic in, is trying to figure out, what is the other guy thinking, and trying to catch him when he's not thinking right. Buying stuff that's too cheap because people have made a mistake. Selling stuff that's too dear because people have made a mistake. And obviously markets can remain irrational longer than you can remain solvent. But that's still, I think, the fascinating thing about market study, and frankly, in my case, in studying economics, is the idea that the economic actors, you and me, we're not rational. And more than that, we're irrational in some very predictable ways. And so it's really interesting to read about, different experiments where they sort of induced irrationality, the endowment effect or the, loss aversion, and they get really, really quirky results because they know how they can induce people to make these sorts of errors. There have been a lot of really great books published on this topic in the last few years as behavioral economics has become more and more interesting to more and more people. They're Animal Spirits by Akerlof and Schiller, Misbehaving by Richard Thaler, Thinking Fast and Slow by Daniel Kahneman, Nudge by Thaler and Sunstein. All of these are about cognitive errors. But it's one thing to sort of recognize that you can create these mistakes in a lab. It's something really different to sort of see them in practice. And from an inflation guy's standpoint, what's interesting is that we are in a fantastic laboratory for these errors right now, because we have 25 years when we didn't have any inflation. And so we totally forgot how to think about prices and about the price level. And so now to watch people make mistakes that are predicated on that erroneous learning that inflation, that the price level doesn't matter, is really fascinating. So I want to talk about three of these errors in the context of housing. And one of them really isn't it's a behavioral error, but it's maybe not in the same kind of sense as the Daniel Kahneman behavioral error, but it's the classic one of fighting the last war. When you look around and you read about the things that people are saying about housing right now, and how houses are too expensive, and so foot traffic is way down. If you look at some of the housing surveys, or the how bad affordability is, and that leads some people to to say, wow, we're going to have this big housing bust. So let me recap the data we got over the last week. And there's kind of two big reports. One of them was the existing home sales report last week, and then the new home sales report this week. And just in case you're not familiar with those reports, the existing home sales report is the big one. That covers most sales. Most homes that are bought and sold in the United States obviously are existing home sales, because the existing stock is much larger than the stock of new homes being built. And so that's the one we really care about. And last week, there was a disappointment in the number of homes that were sold. Not a major disappointment, but a minor disappointment. Sales fell 2.4%. They'd been expected to fall a little bit, but maybe not that much. But interestingly, I don't look at that data, at any of the housing data for unit sales. I actually look at it for prices. And the median price of an existing home rose 4.4% month on month in April, 14.8% year on year. But only 2 years since the year 2000, in only 2 years has the April increase in prices been that large. Housing prices are very, very seasonal. They tend to rise a lot early in the year. And so April tends to be a big month. But even with that, the 4.4% we got was bested by only 2 months out of the last 22 years, only 2 Aprils, I should say. And one of those was in the years leading up to the bubble in 2005, and one of them was a couple years after the bubble had burst and we were bouncing. So they were very unusual circumstances. So it was a big, big price gain. The new home sales data was, in terms of unit sales, really bad. It was 15% worse than expected. And so the number of new home sales is now, which had sort of boomed over the last year or so, is now kind of back to the high end of what had of the levels we'd been seeing prior to COVID. So, but they really sort of, belly flopped in terms of unit sales. In terms of prices, the median price of a new home went up 3.6% month on month, and again about 14.6% year on year. So again, big price gains, even though fewer units are turning over. And so you read what people are writing about this, and a surprising number of them are writing as if they're anticipating a housing bust, because of course, we've just seen this big run up in prices. And the last time we saw a big run up in prices in, the mid 2000s, we then saw a horrible bust and we saw prices plunge. And in fact, going into that event, it was commonly said that we'd never seen housing prices decline on a nationwide basis in a calendar year before. And depending on how you define it, that was true. And it's very, very rare for houses all over the place to be going down. You can have individual markets that where you have bubbles and busts, but it's very, very unusual to have the whole nation do that. And the reason it happened was for a very, very unusual circumstance, and that was that banks were in horrible shape. They were ridiculously over-levered to housing. And so you had this contagion that passed through these poorly capitalized banks, or banks that turned out to be poorly capitalized. And that ended up getting so housing prices started to go down. People started mailing their keys back to the bank. The banks had to flush them out because they couldn't afford to carry them, and that led to this big housing bust. We are not anywhere close to that circumstance right now. The inventory of existing of homes that are out there is incredibly low. There's fewer than 1 million existing homes for sale out there. Fewer than 1 million. The lowest we've ever had in April. Until last year, we'd never seen an inventory of less than 1 million homes out there, going back to, as far as the data goes, which is to the early 80s. And so, we're not really in the same circumstances that we were in 2007 when we had, burgeoning inventories of homes and everybody kind of wanted to get, collect their winnings and go. So error number one, fighting the last war. This is a very different housing market. Moreover, the support for the housing market, the banking support for the housing market is a very, very different thing. Lending standards have not gone all crazy like they did in 2007, so it's a different thing. And so I would not expect the same outcome anyway. Error number two is a theoretical error. And now we get into sort of the really sort of fun things. And that's this idea that because home sales are going down, therefore prices should go down too. And so this is really this is tied up in the same kind of misconception that I'm always talking about with respect to GDP generally, that deflation is not caused by a lack of growth. You can easily have prices and quantities doing different things. And it's less true if you're looking at a particular product market like housing than it is in if you look at the entire economy. But we have the backdrop here of an epic rise in the money supply. That is a tide of money, and that is pushing the price level higher. And this is where we get into this problem that people don't know how to think about the price level. For a quarter century, it was okay to have sort of the shorthand of assuming the price level didn't change very much, because it didn't change very much. But now it is. Now the amount of money in the system also, it never used to change a whole lot. Now it changed a whole lot. And so we are seeing a step change in the price level, and people are not very good at sort of thinking about that. People are thinking about waves. Something goes up and then it goes down. It goes up and goes down. But they forget about the tide, because for a long time we've been in this situation where the tide was turning and it wasn't doing a whole lot. But now the tide is coming in. And so regardless of what the waves are doing, the waves are going to hit higher and higher on the beach. And it doesn't matter how much the wave is going back out. If the tide is coming in, it's eventually going to swamp everything. And so, just to kind of put some numbers on it, just for funsies, since 2010, the money supply, M2, has risen 148%. By the way, a lot of that in the last couple of years. And home prices are up 122%. So, the amount, based on the amount of money in circulation, the dollar is worth less than it was, and homes valued in dollars are worth more. But those numbers aren't outlandishly different. If anything, you'd look at that and say, well, maybe housing prices should be up a little more than that. And in fact, if you go back further, so I said 2010 because I wanted to measure from the trough of the bubble, of the post-bubble bust for houses. So let's be as flattering as possible about how much home prices have gone up. And even being super flattering about that, the money supply has grown faster. And in fact, if you look at the two charts side by side, you'll see that the inflection in home price acceleration a couple of years ago exactly coincides with the inflection in the money supply growth. So not super surprising. Home prices are going up to a new level driven by these tides. Now, if you go back to 99, you'll see that M2 is up 370%, and home prices, and now we have a bubble and a bust in there. Home prices are only up 271%. So, again, it's arguable whether home prices should go up as much as the money supply. Probably not. But just as a rationality check, it just doesn't sound like it's like home prices are wildly out of kilter. It seems like, given the fact that the unit we're measuring prices in is becoming less valuable, it doesn't seem at all inconsistent that home prices should go higher. So in the same sense that we can have stagflation, we can have growth go down and still have inflation go up. That's not inconsistent. Growth does not cause inflation, and recessions don't cause disinflation. In the same way, we can have unit sales of houses go down while prices of houses still go up because the tide is carrying them higher. That takes us to error number 3. And error number 3 is a perceptual error. And again, this is getting to the really, really fun stuff. We are accustomed to, we think in nominal space, which means we think in terms of the price that we see in dollar terms. We don't think about it. We don't think in inflation adjusted prices. And partly that's because we've been trained to do so over 25 years. I said recently in a column, I said, we have 2% glasses on. We see everything in the context of a world that for 25 years, inflation was at 2%, and so you could more or less ignore it. Money supply growth was low. You could pretty much ignore it. And so now when you see something like a 14% rise in home prices, you're like, oh my God, that's crazy. That looks like a 12% real rate of growth, except it's not a 12% real rate of growth. Okay. 14% now with inflation at 8 is the same as 8% home price growth when inflation was at 2. It's the same thing. It's a 6% expansion in the real value of that home. And so you can't just look at that 14% number in a vacuum and say that's high or low. You have to look at it relative to inflation. And that's something that we are just totally out of practice with. And then, by the way, it's kind of akin to, Americans and the way Americans think of foreign exchange. If you go to Europe, and this is less true now because most of Europe uses the euro, but people naturally think in terms of foreign exchange. They naturally, understand when the pound sterling is getting stronger or weaker relative to euro. They kind of know how to do that math in their heads. And Americans don't do that very often. So it's, we're not in great practice. But that's exactly what's happening when you're looking at inflation. When you're doing the conversion between nominal prices and real prices. Okay, this price today is 8% higher than it was last year. Oh, that's really unchanged because we have 8% higher prices overall. The value of the dollar as a unit is 8% lower. So a price that's 8% higher today is just reflecting that. And so that's a foreign exchange. That's a conversion there that we have ignored for a long time, and now we have to go about learning again. And I just think that's fascinating. Is 14% too fast for home prices, even with inflation at 8%? Yeah, probably. I mean, I would expect home price growth to slow a lot. It may even go down to the level of inflation. It may even go down below the level of inflation. But that's not, it's not as crazy as you think because you're thinking with this backdrop of 2% glasses. So, like I say, this is all fascinating stuff to me, but it's wonderfully instructive now to get numbers like this and to break down why it is that we have these certain reactions and why those reactions may not be kind of the rational, the truly rational reactions if you actually really look at the fact that the price level is changing. And I think that it's an important context for almost everything we do. It's an important context when you get a 2% raise at work or a 5% raise at work, and that used to be a great raise. And now you look at a 5% raise at work and you're like, yeah, but my prices went up 8%. So my cost of living went up 8%. So it's actually a pay cut. We have to get used to thinking in those terms a little bit more. And of course, with wages, we we're quicker to make that adjustment mentally. But anyhow, so that's all I want to say about housing and 2% glasses and tides and waves today. Thank you for tuning in. As I said up top, I really appreciate all the cards and letters, metaphorically speaking. You can contact me at inflationguy@enduringinvestments.com. As I said, you can follow my blog at mikeashton.wordpress.com. Follow me on Twitter. I'm at inflation_guy, and you can download the Inflation Guy mobile app. I recently started writing a column exclusively for investing.com, and you can go over and look at that. They're not paying for advertising, but what the heck, I'd like you to follow me there too. And you can visit enduringinvestments.com. Most importantly, never forget, defend your money. If inflation is coming for you, remember, you know a guy.